Slow down. What does it mean for the Fed? Supposed to cut rates here, not in the not-so-distant future. So this is the backdrop for that. Doug Flynn with the context joins us now from Flynn Zito Capital Management. So, I don't know, maybe a tough start to the month, right? After Labor Day for stocks. What did you make? I could put it up on the screen on this ISM data. The numbers probably don't mean as much to everyday people, but the fact that it missed expectations is down below 50 there at 47.2. What does it tell us?
Right. So the key number there is 50. You're looking for 50%. Anytime you see a number below 50%, it says that the manufacturing sector is shrinking.
Right.
And that's happened now 5 months in a row, so that's not a good sign. And manufacturing is just slightly over 10% of our economy. So it's a really important measure. And yet this is just another thing that says, hey, the economy is continuing to slow. It might be slowly slowing, but it is slowing. And so that's why all the more reason this is another thing where we're saying, hey, we're going to need to lower interest rates to get things going again.
It's a really kind of an interesting environment, right, when you think about it, because the stock market today, notwithstanding, has actually been running up a lot, and people are more and more positive about stocks. There's a couple of data points on that today that kind of stood out of the headlines. Number one, the number of 401k millionaires, essentially. Number of people have $1 million more in their 401ks at an all-time high. Okay,
right.
And then you look at households, and we'll bring this up in a second, how much they have in stocks. People are really, really bullish on stocks in terms of their allocations towards stocks. Was 42% of their total assets JP Morgan had, the most on record going back to 1952. So both of those things together, you're talking about the economy slowing, tell you people are optimistic, and you wonder whether they're too optimistic.
Yeah, well, you've had a 20% plus move in the last 12 months from the last time, a year ago, the survey. But this tends to happen. If you can actually track the cash flows into and out of various funds, ETFs, and stocks. And what you find, which is often the case, is that at the highs, people are feeling the best, and that's when they want to put the most money in. And, if you look at the weaker times after a correction or when things are fairly negative, they tend to actually, there's outflows. People are pulling money out, which is the opposite of what you want to do. The greatest thing about a 401k, though, and why people feel that they like it better than even regular investment accounts, is because without realizing it, they're putting money in every single week. And that's one of the best things that you can do, is just add through those ups and downs. If you had to wait for every time it felt good to invest, that would be basically only buying at the highs, and you don't want to do that. You want to buy through the lows as well, especially with retirement money like this, which you might have for 10, 20, 30, 40, or even 50 years.
Speaking of feelings, though, you think about that for a moment. If you look at your 401k, it's over $1 million as more people are in that position. But even if it's not that, but it's going up, you do feel better. And that,
yes.
Even you're obviously not cashing it in if you're not near retirement. But I wonder how that plays into things. I always think of it through the prism of an election. But, you feel better.
Yes, there's a wealth effect. There's no question. People open those 401k statement. They actually look at their statement. We can even see how often people are checking in their account values. It's all higher during those times when it feels good. They want to have something to feel good about. Even though other areas of their life may be a little tighter or things aren't as good, it looks good that, hey, my 401k is at an all-time high. That being said, most people are probably perhaps over-allocated to stocks, especially if you're older, and times at the all-time high are times when you might want to rebalance down into some fixed income and some other areas, which is hard to do because the market's doing so well. But those are the times that you want to look at doing that. Obviously, if you're in your 20s and 30s, keep it going. But when you get older and you're 100% stocks, perhaps these are times to dial that back a little bit.
A little different allocation. Thank you, Doug. As always, we appreciate it. Closing bell time here.